Let's go to page 31 next. When we get there, we're going to talk about flood insurance deductibles. You might say, well, why do I care about deductibles? Well, this is where the flood insurance compliance requirements start to fringe over onto the safety and soundness area. But we've got guidance out there that says you need to go there. And one of the reasons you need to go there is the first item underneath letter C1, which says you can't allow a borrower to choose a deductible that allows them not to have insurance. So let me help you understand that. If you look at number 3 on page 31, you've got in letter A the minimum deductibles, and there's a range of 1,500 or I'm sorry, 1,000 to 2,000. Okay, if you look at those things as a whole, we'll come back and talk about how those things are split out in a moment. The maximum, okay, if you look in B 3B, is 10,000 for residential and 50,000 for non-residential. Now, this is just like any other insurance. When it comes to flood insurance, the higher the deductible, the cheaper the premium. As the deductible goes up, I have to put more in out of my back pocket in the event of a loss. Therefore, my premium's a little cheaper. The higher the deductible, the cheaper the premium. So there's something to be gained from the customer's perspective for choosing a higher deductible. They have that lower premium. So if the maximum is 10 and 50,000 respectively, let's just pretend for a moment that I've got a $20,000 loan, and it's a commercial loan. And the building, let's just say the building's worth, 30,000 or whatever. Okay, so the lesser of there is going to be the $20,000 loan. The building's worth 30,000. You know what? As the customer, I'm going to choose a $25,000 deductible. I can't have that because then there's no insurance. So you have to have a deductible that's equal to or less than the amount of insurance that's required in connection with the loan. Now, if you heard me, you did hear me correctly. I said equal to or less than. They will sell you insurance with a deductible equal to the amount of insurance. I don't get it. It's like you don't have insurance, but that would technically pass the compliance test. You can't allow them to have a deductible greater than the amount of insurance that's necessary in connection with the lesser of calculation. Now, there's some more to this deductibles game. C2 says that just because the customer can achieve a cheaper premium by way of a higher deductible, it's not in the best interest of the bank to allow that to happen in every case. There's a safety and soundness consideration. Does your customer have the capacity to repay that deductible, and it's a higher deductible likely, in the event of the loss? And so what the guidance suggests is that you essentially are underwriting your borrower's ability to repay that deductible that they've selected. It's not a safe and sound practice to just allow all borrowers in all situations to have the highest deductible so that they can have the cheapest premium. They may not be able to pay in the event of a loss, and that brings to you a safety and soundness risk.